Rachel Reeves is coming for your ISA, sort of. Stocks and shares ISAs are technically no longer going to be completely tax-free. You probably have seen this. There's been other videos made, and I've actually got my notes in front of me. It's relatively new, this bit of news, but there's now a plan to tax uninvested cash in stocks and shares ISAs. That's the headline. Honestly, I think there's a lot of fear mongering going around because it's good for clicks. So I wanted to break it down properly with some numbers as well. And as I said, I've got my notes here. This is going to be a relatively unscripted and conversational video. We're going to go through what the change actually is, who it impacts. I don't think many people saying that why it still is just bad, and I completely disagree with it, and what they should do instead, and then what you actually need to do. And I'll also try and timestamp that down below if you want to jump between them. So for a very quick bit of background, you can see now it's unscripted. I'm stumbling over my words under the pressure. In 2025, it was confirmed that from April 2027 onwards, the cash ISA allowance was being cut for under 65s from 20k to 12k. Still the overall £20,000 allowance, we can only put 12k in a cash ISA. Fine, that's locked in. A lot of people, myself included, realized you could then just park uninvested cash in a stocks and shares ISA and essentially get a cash-like rate or an interest, essentially a similar savings rate by finding that loophole. And that essentially now is what the government is closing by introducing this 22% tax on uninvested cash inside of stocks and shares ISAs. And that really is their headline of what they're doing. And that's going to be coming in from April 2027. So just to be clear, it's a tax on interest that you earn on cash inside your stocks and shares ISA. So not money you put in or sort of gains you've made from your stocks and shares, just on money that isn't invested inside your stocks and shares ISA that's earning interest. That interest is going to be taxed at 22%. I mean, technically, don't get me wrong, and the annoyance of this is, it now means that ISAs are no longer 100% tax-free. I guess the beauty of really ISAs in general was that any profit that any ISA spits out is tax-free, but that's not the case anymore. The 22% rate as well isn't random, because from next year, the rate of savings tax was already planned to go up from 20 to 22%. And then 40 to 42 and 45 to 47, depending on whether you're a basic, higher or additional rate taxpayer. So that's sort of aligning these rates with savings rates. And that's all this, both those changes are going to come in together along with a cash ISA 12k cut. So sort of a unified, like, trio turd, if you want to call it that, of bad changes. That wasn't in the script, of things that are going to come in. So that's essentially what's happening. You probably know that already. So who does it actually impact? Sorry, because that's the bit that's getting a bit lost, I think, and it probably won't impact most people. It probably won't impact me. So let's just run through it. I've got some bullet points here. If you've got a cash ISA, you're fine, no impact. If you've got a lifetime ISA, once again, you're fine, no impact. It's only on the stocks and shares ISAs where you have uninvested cash. So if you have a stocks and shares ISA and you're fully invested, you have no cash in your stocks and shares ISA, all your money's in index funds, ETF, stocks, this will barely affect you. The people it actually impacts are those who keep chunks of cash sitting in their stocks and shares ISAs earning interest. Those who maybe put 20k in their stocks and shares ISA at the start of the year and then invest it monthly across the year. There is a bit of a cash drag with that anyway. It's generally better just to lump sum invest. But those people will also be affected. People who hold income funds get the dividends paid out as income and then keep that income in cash, they'll be impacted. I actually think accumulation funds, which I use in general anyway, because I like the automation of them, are about to become a lot more popular. And people who trade a lot. If you're a trader and you day trade inside your stocks and shares ISA, you essentially might have some cash that sits in there. I mean, it could be thousands of pounds, I don't know. And I think they're the main people it's going to impact. The massive thing is just the admin of all of this, particularly if you are buying and selling often, you have some cash that sometimes sits in there waiting to invest, or from your accumulation funds. Just the admin nightmare is going to become, that admin POV is going to become a nightmare in my opinion. And the thing is, I think for most people watching this, the actual tax bill is going to be tiny, because you're probably investing monthly automatically into your index funds or ETFs. you probably don't have thousands of pounds in cash sitting there. There might be a little bit of cash that sits in there at some point, and it will be a faff to work out exactly how much cash you've had across the year, for how many days, earning what rate of interest, what tax is then due. That is going to be a faff. And I reckon it's going to have to be on the platforms or the brokers to actually work this out. Because from our point of view, I mean, even often actually when you set up an automatic investment, say with like Vanguard, your money will sit in cash for a few days being pending. Does that count as uninvested cash? I assume not, because the money's not actually earning interest, so there's nothing to tax. But I think the platforms, actually, thinking that one through logically, that should be fine. But it's going to become an admin nightmare, and I think the platforms are going to have to do some stuff to work that out. To try and put some numbers around this, so I looked at the latest HMRC data, and this is from April 2024, although I think it was released in April 2025. There's about 872 billion in ISAs across the UK, a couple of years old, of course. Of that, 511 billion is in stocks and shares ISAs. Lloyds then forecasted by this tax year, there'd be about 1 trillion in ISAs with 600 billion in stocks and shares ISAs, which is a projection. But using that sort of latest published figure of 511 billion in stocks and shares ISAs, I don't think there'd be much in uninvested cash. From my experience investing and just talking to people, people just add cash and invest it straight away. Unless there are those people who are probably the ones that are more switched on, trying to get around this loophole by adding cash to their stocks and shares ISA. I guess, unfortunately, they will be negatively impacted now because of this. But I think there's maybe 10% of cash in stocks and shares ISAs is uninvested. So that becomes 51 billion of taxable money. And if you're earning a 4% interest rate on this, that's about 2 billion a year in total interest across the whole country, taxed at 22% from next year, and you get 440 million for the Treasury. Of course, that's a massive back of the envelope calculation. But I think the thing is, it's not really a fortune based on the government's run rate of how much they spend and how much they need to plug all their holes, which is why I just think this is a bit pointless. And now I'm gonna get into my sort of honest opinion. So this is ultimately what the video is about. I don't think, even though I guess the numbers aren't massive for the government, I don't think it'll raise that much money. It's a faff, but it's very easy to avoid. And I don't think a lot of people will be impacted anyway. It's just now really two things. One is the president sets, and one is the overcomplication unnecessarily. So to go into that one, it's really overcomplicating ISAs for no real advantage. I mean, ISAs work. They're tax-free, they're simple, they're easy to understand. But now there's this carve-out where there's a specific element of a stocks and shares ISA that isn't tax-free. So it's going to be just such a silly, unnecessary overcomplication. And the fact that ISAs in general are now completely not tax-free, and people are already under investing, under saving, adding more compliance and more tax to it is just going to put even more people off. I mean, if you are watching this video, the chances are you like talking about money and watching investing content. You probably already use ISAs and stocks and shares. But the thing is, most of the people in the country don't, unfortunately, which is why this is so important. Only 15% of people, roughly, when I last looked, have a stocks and shares ISA. So now adding even more tax and even more admin and compliance and overcomplication is just going to be a nightmare. And the actual tax raise, I don't think is going to be that much because it's going to be so easy to avoid. And also the second point I think on this is the president of this sets, where if they can now do this and change ISAs, you know, what else could they do? Could they cap how much you can put into an ISA, or cap the value at a certain level? Could they increase these tax rates? Could they start taxing other gains? Like, who knows? And this is usually how these taxes work. They introduce a little tax to warm things up and it doesn't impact many people. But then over time, more and more people get impacted. It's happened with a lot of taxes over time. And I think this is going to be another one where this happens again. And it's really the thing as well. I feel like with ISAs particularly, they really are used by working class and middle class people to try and get ahead. They're doing the right thing, they're saving, they're investing, they're using these tax wrappers that they should be encouraged to use, and adding all of this in is then punishing people that these things are meant to benefit. If you are an ultra wealthy millionaire, billionaire, the ISA allowance is irrelevant. You can probably max it out on day one. If you're investing hundreds of thousands of pounds a year, you probably have financial advisors, and this is irrelevant to you. It's literally just going to negatively impact those people. Most people don't even max out their ISA allowance or pension allowance. I've never maxed out either. And it's just going to negatively impact those people and actually turn them off investing or saving because of this overcomplication. And I think the knock-on effects of that are just not going to be good. The other bit as well, which is worth noting, and I probably should have mentioned earlier on, is the transfers. So from April 2027, if you're under 65, you also can't transfer money from a cash or innovative finance ISA into a stocks and shares ISA to get around this. So it's also going to make it more strictly from a transfer point of view. You already can't transfer lifetime ISAs, I don't think, to the other types of ISA. But it now means from next, you might have some changes to make as we're going to come on to, but from next April 2027, you're then locked in. So there's less flexibility, less ability to change your mind, more irreversible decisions, which again, is just overcomplicating things unnecessarily. And that's probably the buzzword for this whole video. We've got a couple of more things to get through. Encouraging people to invest is really the whole point of this, which of course I agree with. I've been talking about investing online since 2019, so I massively agree with that. People need to not just actually invest more, but also actually have an interest. What is their workplace pension invested into? Opening up the best stocks and shares ISA for them. But adding extra tax and making cash less appealing isn't going to get more people investing. It's just going to turn more people off, particularly the normal everyday working person that should be using these type of accounts. And I think if they actually wanted to take advantage or encourage people to invest, some simple things to do is to actually increase the ISA allowance. It's not increased in line with inflation for years. Imagine they increased it and it was plastered all over the papers, all over social media. It would once again get people's cogs turning to use ISAs. Scrapping stamp duty on UK shares, which is 0.5%, doesn't raise much anyway, and there's another extra tax that we pay. Simplify ISAs in general. I actually made a full video on this, where if I was the ISA minister, what changes would I make to actually simplify things? And I think honestly having a savings ISA, an investing ISA, and a home buying ISA, one purpose, one allowance, all works the same pretty much, is the easiest way to simplify and get more people to use them. And I'll link that whole video at the end as well. I've had, I think, 9 or 10 ideas on how to actually fix the ISA system. Financial education, of course, is always important. We try and cover it online, me and other people, but really in schools is so important, even the basics. Bringing in more proper free guidance that people can actually access. And most importantly, to be honest with you, the overarching one, stop changing things unnecessarily. Compliance, confusion, admin, it all turns people away and it's just unnecessary, essentially. And I do apologize. I feel like I'm repeating myself. But what is the actual practical bit? I'm actually quite happy with this. This is unscripted and nothing's really, or sort of unedited. Nothing's gone wrong so far. But what is the actual practical bit? What should you do? And I've got 5 key bullet points here. So the first one is to actually look at your stocks and shares ISA and see how much cash you typically have in there. If it's just a few quid, realistically, you're not going to be impacted that much. And I assume there will be some, I don't know, software that platforms introduce that track it well, so you know how much interest is actually, how much tax on your interest is actually due at the end of the year. Another thing I've just thought about, like most people don't do self-assessments. I don't know how this is then going to be paid. More people might do self-assessments or like manually pay the government this money, unless the platform's going to collect it. Once again, the admin and compliance is a nightmare. But yeah, have a look. And this is actually why I think accumulation funds are going to become a lot better to use, because accumulation funds reinvest all the money. You never see the income. You never see the cash that hits your investing account. So the risk is the cash hits your investing account. You don't realize for 3 months till the next dividend hits. And this goes for individual stocks as well. And then all of a sudden you have annoying a bit of interest you need to pay, or tax on the interest on the cash you've held in your investment account accidentally. So I think setting up accumulation funds instead of income funds and dividend reinvestment plans for any income is probably going to be just better to use, because it will save you sort of faff from this new tax point of view. 2, I guess as well, I've alluded to, is actually work out if you're going to be impacted and how much you think you'll pay. And if you can make some changes now to make sure you're not impacted, it's probably the easiest way to go about it. I think that's what I'll do personally. I already use accumulation funds and invest automatically, but I'll just make sure I never have cash sitting in a stocks and shares ISA again once this comes in. 3, of course, if you've got a cash ISA, lifetime ISA, you're fine. This is just uninvested cash in stocks and shares ISA specifically. I'm also melting. It's still 32 degrees. So yeah, not a good day to be recording this in the conservatory. Number 4, yeah, if you do then have meaningful cash in your stocks and shares ISA, I think you need to sort of decide whether you want it in there and invest it, or move it to another type of ISA like a cash ISA where the interest will be staying tax-free forever. So you probably now have a bit of an inflection point. We need to make a decision. Are you going to invest that money, that uninvested cash, in your stocks and shares ISA, or are you going to move it? You of course got, quite a while to think about it, but that's probably really the big decision for some people. And in going forward, just simply not keeping uninvested cash in your stocks and shares ISA, because that's going to be unneeded in tax. You need to pay on the interest. And fifthly, which is more of a general point, but it's probably worth pointing out, and I banged on about this a bit over the time on making videos on this channel. I think it's really important to always have a split between ISAs and pensions, just as a good reminder. Because if the government do come in and nuke one, although pensions are now going to be subject to inheritance tax, and there's been changes there recently, now ISAs are changing. So maybe we're not safe, but normally if one changes for the worst, hopefully the other one doesn't. So I think having both, ISAs, cash ISAs, stocks and shares ISAs, and pensions, whether a workplace pension or a SIP or both, is good. Not just diversification in your actual portfolios, but across the tax wrappers, just so you're a bit better insured in case more and more changes do keep coming in. That's my take on all of this. I'm of course not a financial advisor. It's just my personal view on someone who follows all of this and is very passionate about talking about financial education, investing, index funds, all of that good stuff I always cover on the channel. Of course, if this is the first video you're watching of mine, my videos are normally a bit better edited and flow a bit better than this. This is very much off the cuff, given that it's been a very recent announcement and I wanted to get a video out on my take on it, as I've been getting a few questions on it. Overall, I think this is a sort of fix, or it's not really a fix, but the government is creating a problem, overcomplicating ISAs for no real benefit. It's mainly going to be a negative for working and middle class people, and it does set a worrying tone and precedent of what's going to come next. I mean, yeah, ultimately, just at least from April 2027, never keep any cash or uninvested cash in your stocks and shares ISA, and you'll never have to worry about this. But I do think a lot of people are going to find they accidentally have cash balances at some point, and then in April 2028 realize they have tax to owe, and it's going to be a massive faff. And I can see people kicking off, and I completely, wholeheartedly understand why, as this just seems unnecessary in my opinion, and there's better ways to incentivize investing. And I'm not a tax expert or advisor, but surely there's also other better ways to raise tax rather than coming for the best vehicle, or one of the best vehicles other than pensions, for us to save and invest in the UK. What do you make of this? Let me know in the comments down below. I'm honestly really curious. I don't know if I've been too soft on the change or like too hard on it. I guess I've sort of been somewhere in the middle, maybe trying to be a bit more impartial, and hopefully most people, I guess the most important thing at this point is as well, understand this is going to come in and spreading the word. Feel free to share this video with people who you think might find it useful, because then you can actually make the necessary changes to your portfolio, investments in cash and all that stuff, to your ISAs before the change comes in and actually negatively impacts you from April 2027. So at least there's a bit of time to make the necessary changes. I also, as I mentioned, did create a full video on how I think the government should fix ISAs. So I'll link that somewhere on the screen if you do want to watch that one next. But yeah, unfortunately, this is not great news. I don't know if they could backtrack on this. It's been all over the press, so I assume it's going to be announced formally soon. But yeah, thanks for watching. Let me know what you think of it in the comments down below, and I'll see you in the next video.